why an IUL, Indexed Universal Life Insurance Contract, is the perfect fund or repository to manage your real estate. My money's safely tucked over here. If the real estate is doing well, I benefit. But when the real estate goes down in value, I don't lose a dime, and I'm going to show you that. Well, I'm still going to get out of debt fast by giving it to the mortgage company. And I'm going, you're not getting it. Whatever you think you're doing by giving it to the mortgage company, I will get you out of debt about two and a half years faster. Get ready. I'm going to show you why it's my favorite vehicle, and many thousands of clients have used it to manage their real estate equity. These are savvy real estate investors that make millions in real estate, okay? They don't own just one little rental property or whatever. And I think you're going to be blown away when you understand the versatility behind IUL. I call it a financial Swiss Army knife. It's the dream solution for many goals. We're going to zero in on this one right here, real estate management. Get ready. So I'm Doug Andrew. I've been a financial strategist, retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets and minimize tax. Now, amid all of these clients I have, many of them are pretty serious real estate investors. They own multiple properties, or some of them are like me. They really don't like to be a landlord, so they buy up properties, fix them up and flip them for a profit. And they do it the absolute smart way because they understand how money works. So get ready. I want you to understand this, or you're going to miss out on opportunities maybe you didn't know existed before. So let's go through a simple example to illustrate what I'm talking about. And I want you to get it, or you're going to miss out on opportunities that you probably didn't know existed before. When somebody comes to me and they share that they own maybe a rental home or rental properties, and they're sending extra principal payments, let's say $1,000 a month in extra principal payments against the mortgages on those rentals, or maybe even their own house. And they go, yeah, we want to get out of debt and we want to hurry and pay off the mortgage. I go, well, that's a good way, but it's a far cry from the best way. And they go, well, what do you mean? I go, well, if you were to sock away that $1,000 a month that you're giving to the mortgage company and put it instead into a properly structured max-funded IUL, it is compounding tax-free at a rate of return that has averaged historically double to triple the net cost of the funds. Do you understand how money works? And they go, well, we thought we did. How do banks make money? They borrow OPM, other people's money. And in 2008, they were borrowing OPM and only paying 1% or less. Every million, they pay $10,000 a year in interest. They were turning around and putting some of that money into insurance companies earning 5. How much more is 5 than 1? Don't say 4. It's 500% more. They're making 50 grand and they only pay 10 grand. Would you hire an employee for 10 grand that made you an extra 50 grand? Yeah, that's a 500% return on employment cost, okay? And so you'll actually get out of debt by using compounded rates of return, tax-free. You'll have enough money in this compounding account to pay off those mortgages in one fell swoop 2.5 years faster than your method of giving it to the mortgage company, okay? Now, some people watch my channel and they go, oh, I'm just going to hurry and pay it off my way. You're not going to be doing it in a hurry your way. Whatever method you think you're going to get out of debt in how many years you think that's going to be, you could lop off another 2 or 3 years by doing it my way. So, when people say, oh, I'm just going to do it my way and get out of debt faster. No, you're not. I can show you whatever you're doing, you could get out of debt faster by not giving it to the mortgage company, okay? Now, sometimes people say, well, I'm sick and tired of this particular rental. It's like an albatross around my neck. We're taking out the trash, fixing toilets, evicting tenants. We just want to get rid of this thing. And sometimes they don't want to do it because they're going to have to pay a capital gain tax on it. And I go, just bite the bullet and pay the capital gain and take the net and put it into an IUL. And they're shocked when they see the IUL is growing and generating income, if they need the income, that is far more than what the rental income was generating after all the costs of maintaining the property, okay? Sometimes people, they pay off their home and then they want to sell it and pay cash for 2 retirement homes. And then all of a sudden they read my book or watch this channel and they realize, hey, if we pay cash for our retirement homes and 90 days go by, we'll have forfeited the ability to deduct the mortgage interest on our tax returns the rest of our lives on that property. The best way to resurrect tax deductibility is oftentimes by mortgaging the new properties. And people say, well, I just take the standard deduction. Then you don't understand how to make it deductible by using it in other ways, like for business. I borrow on my real estate for business purposes and it's tax deductible. You don't have to deduct it as mortgage interest on your tax return if you're qualifying just for a standard deduction. But people, they don't understand because, frankly, they're simpletons. So don't pass up the opportunity. Many times we have gotten money out of people's IRAs or 401ks, totally tax-free, saved them $250,000, $750,000, $1.2 million by resurrecting deductions when they sell their house and buy new retirement homes and keeping them mortgaged, and they end up making at least double what the net cost of the mortgage is, but they're able to resurrect deductions that offsets the money they take out of their IRAs or 401ks. That's a strategy that you ought to see by checking out what a strategic rollout is. So folks, the key elements of a prudent investment, okay, is number 1, liquidity, the ability to access your money when you need it. Number 2 is safety, not only of the institution, but safety of your principal. Anytime I set aside money, I don't want to jeopardize that money I set aside. But any year that I make money, I want that to become newly protected principal. Number 3 is to earn a rate of return that historically has outpaced inflation, which IUL has always done for me. And so real estate equity fails these 3 tests. You can't get your money when you need it. When you need it the worst, it's the hardest to get because you have to qualify to borrow it. And if you're unemployed or disabled, good luck, okay? Or you have to sell the property, and often when you need to sell it to get your money out of there, it's not a good market. I keep my money in IUL because I can access money with an electronic funds transfer or phone call anytime I want, okay? And it's not subject to loss when the market goes down. It's safe from market loss because when the market goes down, I don't lose my money in my IUL. I may not make anything that year, but I don't lose. And in a year the market goes up, I make money. That's called indexing. And so I'm able to earn a rate of return that I link my returns to the things that inflate. So I've always earned a rate of return that is usually double or triple the net cost of borrowing the money on a mortgage, but also it outpaces inflation. So money has to have a home. Let's go to the story of the 3 little pigs to illustrate this. See, real estate is a moderate risk investment, and I would classify that as like the houses of sticks in the story of the 3 little pigs. The stock market would be like putting your money into the house of straw because the stock market is very volatile, and it can drop several points in a single day and in a single month, like March of 2020 due to COVID-19, it dropped 30% in 1 month, okay? Our clients never lost a dime. In fact, when there's anxiety, there's opportunity. They seize the opportunity to lock in the next year 61.33% gain on their IUL because of that downturn. But see, if real estate, which doesn't react quite as violently, but real estate can go down in value, and I'm going to show you an example like 2008. Over that year, my house went down in value from $1.5 million to $1.1 million. I did not lose 1 dime when my house went down in value $400,000. Okay, stay with me to the end so that you get this. I keep my serious cash safely tucked into this house of bricks. And my favorite vehicle is a maximum funded insurance contract, an IUL. And you'll see why, because the big bad wolf, what's the big bad wolf? Some people say the IRS. Well, it's the pandemics, the recessions, the shootings, the terrorist attacks, the things that cause the value in the stock market and real estate market to plummet, usually pretty seriously, at least once every 7 years. When that goes down, that spells opportunity for me over here. because my money's safely tucked over here. If the real estate is doing well, I benefit. But when the real estate goes down in value, I don't lose a dime, and I'm going to show you that. When the stock market is going up, I benefit. When it goes down, I don't lose because my money is over here, not here, but I link my returns using indexing to that, okay? So when people say, I'm sending extra principal payments to the mortgage company, I say, well, whatever you're doing, if you put that into an IUL, I can prove to you mathematically you'll get out of debt 2.5 years faster than you sending money against your mortgage. And I can prove that mathematically all day long. And so there's a lot of people that say, well, I've got this method where I'm getting out of debt by paying off the highest interest credit card and then the next highest interest credit card, then my car loan, and then I'm plowing all that against my mortgage, and I'm going to get it paid off in 12.5 years. Well, that may be a smart and quick way, but it's a far cry from the smartest and quickest way. So let me prove it to you mathematically here. There was a company that was selling software for $800, and it's like, this is not rocket science. You don't need to spend $800 for this software. But by paying off all these credit cards and car loans, they showed that you would pay off your mortgage in 12.5 years by continuing to just plow it against the mortgage, okay? Which is good. And then they said, sock away what you used to pay and all that debt and put it into a tax-deferred IRA or 401k earning 8%, and you'll end up with $987,000 at the end of the 30 years, okay? Well, that's not all your money. You have to pay tax on that in an IRA or 401k. Only about $650,000 of that is your money, okay? So keep that in mind. All I was saying is, well, I keep that money instead of giving it to the mortgage company. I put it in this pocket, compounding tax-free. This pocket is a laser fund, IUL, and it's compounding at a rate of return double or triple the net cost of the mortgage. And so I have enough money in 10.2 years over here to totally pay off the mortgage about 2.5 years faster than giving it to the mortgage company. Now, there are simpletons who watch this and they go, well, I'm still going to get out of debt fast by giving it to the mortgage company. And I'm going, you're not getting it. Whatever you think you're doing by giving it to the mortgage company, I will get you out of debt about 2.5 years faster than any way you think you're getting out of debt the smartest way. It's not the smartest way the way you're doing it, okay? And so this proved it, and you sock away the difference, you'll end up with $1,245,000, double the amount you're going to net out of an IRA, because this is tax-free. And then people say, well, what do you do, Doug? And I say, well, what I do is in 10.2 years when I am out of debt, I don't physically pay off the mortgages on my real estate because I am out of debt, because my assets far exceed my liabilities. Anytime with an electronic funds transfer or phone call, I can transfer money and pay off all my mortgages. But why would I fire an employee, so to speak, that's costing me, $30,000 a year on every million? That's 3% net interest I'm paying. And I'm making 9% over here in my laser fund. How much more is 9 than 3? I'm making 300% more than the cost. Why would I fire an employee that's making me 300%? And some people don't get that. It's how to become your own banker. But I will end up with $1,844,000 at this end of the same period. So this is good. This is better. This is best. I would rather have an extra $1.2 million than the people who say, well, I'm just going to do it fast and pay it against the mortgage. You're costing yourself $1.2 million. Hello? And they somehow just don't believe it. They think somehow I'm doing smoke and mirror math. No, it's true math. In fact, the Federal Reserve Bank of Chicago back in 2006 were commissioned to do a 38-page report, 3 gurus, because my second book, which was a bestseller, we went through 500,000 copies of that book titled Misfortune 101, and I proved how you could get out of debt faster. And so they did a 38-page white paper, and they actually came to this conclusion. Americans are actually making the wrong choice if they're sending extra principal payments against their mortgage. They called it a misallocation of funds. You're misallocating that money. You would reap a substantial gain if you didn't do that. And they called my method a rather conservative way of optimizing retirement wealth, okay? They had to take 38 pages to prove it. Well, folks, let me make sure you understand this. Again, banks, They borrow OPM, other people's money, let's say $1 million. People put into the bank to earn interest, and maybe they give you 1% interest back. In 2008, it wasn't even that. They're going to pay $10,000 a year in interest to borrow OPM, other people's money. They turn around and put a lot of that money into insurance companies, which is what I do, okay? And they earn 4 or 5. Let's just use 4. They make $40,000 tax-free. How much is 40 more than 10? Don't say 3 or 30. It's 400% more. Would you hire an employee for 10 grand that made you an extra 40 grand? Yeah, that's a 400% return on employment cost. You're not saving money by firing that employee as soon as you can. That would be costing you money, okay? Me, back then, I was borrowing money at 3 3/4 tax deductible, okay? And net cost of 2.5. I was making 10. I was making 400%. The banks were making 400%. We're both happy. You can't believe how many people did not understand this. So in December of 2007, I could see the writing on the wall, and I went out and mortgaged my house 80% loan to value. My house appraised for $1.5 million in December of 2007, okay? So on the $1,100,000 mortgage, I was paying 4.5% interest. And even if I can't deduct it as mortgage interest, I can use it for business and make it deductible. But I always deduct my interest the way the IRS says you can. So that's $67,000, but it's a net cost of 3% or $45,000 because I save that difference in tax, okay? I was making 8 to 10% on that money. How much is 8%? It's $120,000 the very first year before it even starts to compound. How much more is 120 than 45? I was making $75,000 profit on top of whatever my house would do if it went up or down in value. What did it do? It went down in value. It went down in value to $1.1 million. I had critics go, neener, Mr. Andrew, you're underwater. You owe more than your house is worth. Did I care? No, I was in control. That extra $400,000, I had borrowed at 6%, tax deductible, and net cost of 4. It was costing me $16,000. I could peel off just half of the 8% I was earning on that $400,000. That's $32,000. I only needed to pull out half of that to make the mortgage payment. And that's 100% more. I was making 100% more than the net cost of the mortgage on $400,000 of equity that would have disappeared for years had I left it in the house. If I left it in a paid-off house, I would have lost $400,000 for several years before my house finally came back to $1.5 million. I didn't lose a dime. I was making 100% rate of return on $400,000 of equity that was no longer in my property for several years. Are you getting it? Okay. Now, this is called leverage. Leverage, though, without liquidity is stupidity. You don't go leverage by borrowing 100% and putting 20% down payments. I've never paid a down payment for any piece of real estate I've acquired. You can watch episodes on this channel to see why. I've satisfied down payments, but never with my money. When you have no liquidity, that's when you get into trouble. So how does the math work out? On just $100,000 of equity that I keep separated from a piece of real estate, if I borrowed at 6.5%, and again, I would do that even if it wasn't deductible, because I'll come out ahead, because I'm earning 8.5, tax-free. Compound interest versus simple interest. But if that's tax deductible, it's more than just 2%. Because I have critics go, you'll do all that for 2%? And I go, yep. Why? Because math does not lie. If I did that one time on just $100,000, it's an extra $1 million over a 30-year period. Just a 2-point spread. That's how money works. But the difference between arrivers who arrive at $1 million versus thrivers is thrivers end up with $4 million. How? They repeat the process. It's not a one-off. If you refinanced every 5 years and your house went up in value only 5% per year, which is conservative, on a piece of property, you would end up with $4 million instead of $1 million by repeating the process. It's not costing you anything. It's making you money. That's why IUL is the perfect fund to manage real estate. So if you want to learn more, the first step would be to claim a free copy of my 300-page book, The Laser Fund. It's been flying off of our warehouse shelves, but I'll gift you a copy free. If you go to Amazon and buy one, thank you. You know, it's going to cost you anywhere from $20 to $60 or $70. That's why I said thank you, but I'll gift you a copy free. You simply click on laserfund.com or the link below, and you contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game, but I'll cover the rest of that, and I'll pay for the book. So I'll fire out a hard copy to you via priority mail. And while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's various formats available there. You can schedule to attend a free educational webinar that we do on a regular basis. But if you want to schedule an appointment to talk to an IUL specialist, a certified professional, then you can see how this may apply in your particular set of circumstances, because the last thing you want to do is set up an IUL with somebody who does not understand how to do it correctly, because you will not see it perform like I've been showing you here. So this is not about me, this is about you. And so claim your free copy, and let's start you on your journey towards your brighter future.